All right, guys. So I'm going to be going over the basics for debit spreads and credit spreads, otherwise known as long or short verticals. Um, so we're going to go over the first part. We're going to go over the long call vertical, or otherwise known as bulk call spread, or just a long debit spread or call debit spread. So principle's pretty fucking easy to set these up. It's always buy a call and then you're going to sell a call. You're always going to buy one call lower and then sell one call higher. So for a little example, it would be buy the 325 and sell the 330. And then we can look at our risk profile to see how this looks. We can add a simulated trade. So go over to Jan 29th. So on TOS, if you're on the desktop, you got to go to vertical. Otherwise, you can go to custom and do it. So you'll have to select one of these and then you can adjust it down here. So like in our example, we'll hit the 325 as the buy, and then the sell is going to be the 330. Okay. So what does that mean? Right. I know it looks very confusing, but all in all, it's not. So we've bought the 325 and we sold the 330. So if we go back to single, we're going to look at the cost of 325. If we were to outright buy the 325 call for the January 29th expiration, it'd be roughly $3.64. However, since we're selling the 330 call, we can take the premium that's on the 330 call and subtract it from the cost of the 325. So that would bring our cost down to roughly, $2.16 is going to be probably the midpoint on our spread, or $2.12 now. Now, how do you determine max profit? How do you determine cost? Well, that's how you determine the cost, just taking the short strike away from the long strike premium. And the way to determine your max profit, it's always going to be the width of your strike. So since we bought the 330, sold the 325, we have a 500 point wide or a $5 wide spread. So the max we can absolutely collect is always going to be $500. But since the cost of our spread is $2.12, the max profit we can make on the trade is going to be roughly
$7.88.
Yeah, $2.88. That's max profit for that spread. The farther we go out with the short strike, the higher the max profit on the spread. So if we swap this to the 325, well, now the width is $10 or $1,000, and our max profit is now roughly, let's just call it, $700, really 680 or something like that, 687. And then that would be the max profit for that spread. And we would hit max profit when our short strike is hit. So if we bought the 325 and it rode all the way up to 335, after 335 or a little past 335, we should no longer see any more profit on the option, because that's where the profit is capped off. You hit the risk profile. Oh, Jesus. Let me zoom that out. Yeah, you can kind of see the risk profile on this. I wish it would set up the whole spread. That's not right. It should be flattened off at one point over here in the spread. That's all right. Yeah, so normally, so like this would be your typical like long call, just unlimited profit. Stock keeps going up and up and up. It would just it's unlimited profit. But normally on this spread, it's probably because I'm on demand. It should flat point right at 335. Wherever your short strike is, it will right here you'll see the normal long, and then when it hits your short strike, right here should go flat. That's what the risk profile would look like on the trade, because there would be no profit beyond the 330 strike, because you're now you're essentially short that strike, and you're trying to profit on the gap between the two strikes, essentially, because you're buying essentially an undervalued width between the spread, and now you're trying to sell an overvalued sense of the spread. Does that make sense?
as long as the stock stays between 325 and 335, you're collecting max profit, or it has to go above
No,
335?
no. So since this is a long spread, the Greeks, still apply. We're still, our sensitivity on this spread is still time decay, volatility, and essentially gamma could work against you, but still we still have a time decay as our main exposure on the spread. Let me jump back to where is it?
What if you purchase a spread that's entirely in the money?
What do you mean? Like if I bought a debit spread that was in the money?
Mhm.
Yeah.
And that
So
just do nothing?
no, there's still profit. You can make profit. It's just really not as much to really gain because remember we have deltas, right? And we have Greeks and everything. So anytime we buy an option, right, that's deep in the money, we're buying a heavy delta weighted option, right? And anytime that we're selling an option that's in the money, which is generally a no because the highest exercisement of an option is always when it's either at the money or in the money, because what buyer of an option is going to want to exercise an out of the money option? No, nobody. So when we buy these in the money options, we take risk of getting a sign on that short leg, and then we'd have to exercise the long leg in case that risk assignment never happened to cover the potential downside. And you'd be looking at like $75 exercisement fees at least. So that's why most people generally don't do it. And you're taking away from the Greeks component, because if you buy the 310 that has an 80 delta, and you come down here and you sell something that has a 70 delta, you only have a $10 10 delta roughly when the two options are combined, because anytime you're short an option, you're short the Greeks. So if this is 70 and this is 80, well, you only have a 10 delta, and then you've canceled your gamma out, and you're adding to actually you get some pretty good reduction in time decay, because time decay is less sensitive out here and you're selling more of it. But you're not adding to your profitability, and you're not there's not going to be as big of a chance for a percentage return going in the money versus playing at the money in going out of the money. You're going to see a better rate of return, especially if something's on the rate of an uptrend. For this, just for long debit spreads. And I'm going to show you the way that I like to enter these and structure them. In most cases, generally for swings. Some people do day trade debit spreads, but I don't recommend. I always recommend it to swing these. I always find them to be much more profitable that way, and a less risky way to enter a swing. If you ever wanted to swing something, you're essentially hedging yourself during a swing doing this. Yeah, so like anyways, we bought the 310, sold 315. Really, there's not much profit gap to really make. You know what I mean? Does that make sense, Dan? Because this is 1100, right? And then you're selling this for 1500. Your cost is $5, and generally the max you can make on a $5 spread is $5. So there's really not any profit to really make in it. You can probably make a couple bucks, but there's really not much to make. Versus if you come down here, you're making, you're trying to capture that, the width of those spreads. There's profit to be made in those. You know what I mean?
Mm.
So the way I like to set these up, so like if I'm looking to swing something, like my principles are 30 to 45 days out, I like to look at the money straddle, because the at the money straddle is a long call and a long put. It has the highest gamma and the highest vega, is the most sensitive option to volatility. And generally we can kind of get a rough implied range of how the stocks or what the stock is going to be trading in. So if we went to the March chain, it's roughly 50 days out, we're going to look at the 325 strike. That's the at the money strike. And we're going to see that's priced for roughly $26.50. So that's a $26 range that we can presume that QQQ is going to move in the time of the expiration between now and, or if we were still in January, now and March 19th. $26 down would bring us to the 300 strike. That's where we at our current today on March 9th, right? So that would kind of make sense that the market had already kind of implied that this range could happen, or we could go $26 higher, which would bring us roughly to 350. Okay, so if we were going to take a debit spread, we're going to use that implied range to structure the spread itself. So we'll go back to the verticals, right? And then we'll select the 325. Okay, so this is where we can go the implied range out. So we would take, you can either choose to structure this, take the at the money and then sell the implied range. So let's say you buy the 325 and then you would sell the 350. That's something that you can do. Pretty good width between the spreads. You got $2,500. Your max profit would be roughly $1,500 on the trades to be, 150% max profit. Pretty good terms. Still, you got plenty of time. You could also do the hefty out of the money range, right? You could buy the 350, right? It's $25 out of money, and then you could sell the 375. Okay, this is generally you're going to see the highest like kind of risk reward setups when you go. The farther you go out of the money when this works. Not that 350 isn't a touchable range, because it totally is. But you're going to see better. So like the cost of this is only $2.60, but the width on it is $2,500. That's pretty good. That's a 1 for 10 risk reward. If you buy, let's say you bought this 10 times, right? It would cost you $2,600, but that one time the spread worked out, you'd make $2,600. It would offset that 10 times that you lost that trade. So let's say you only won 10% of the time on this trade, you still can break even on only winning 10% of the time, or 1 for every 10 or 10 for every 100 trades that you take. Does that make sense in terms of how the risk reward works?
Yes.
Yeah.
And so, like I said, you're constantly playing the Greek battle, right? So at the money, 325 call, 50 delta versus 350, right? And remember, we have added time value, so we naturally have an increased delta. If we go to the 350 on this week's option chain, it's not gonna, there's not gonna be much juice. But we see it's 20 delta here, so it's roughly a 30 delta spread. 30 delta spread is very good. 30 delta is, a couple steps out of the money generally, and we can see pretty good return on the spread that way. Now, if we bought the 350 and then sold the 375, we're not really selling many deltas, and really more so selling volatility at that point. And we're not looking for that short strike to be hit. We're really more so looking for us to cross over our long strike at that point. So you'd be trading what looks to be a 15 delta spread if you were buying the 350 and selling the 375. So again, not bad. And this, that spread going out of the money is, a good risk reward. Chances of it fully working to max profit might not happen, but in the event that it did, tech had another bubble burst, you'd see really high reward on those trades. Same thing, same structure for the put side too. You'll buy a put at the money, you buy 325 put, you're going to sell, the put on the lower strike to be the 310, right? So you'd have $15 wide spread, and it would cost you, hang on, we're on the single. Back to the vertical. Buy 325 put, sell 315. Right, rough $4. Max profit can be closer to, probably $6.50. Again, better risk reward. And this is going to protect you, because remember, in the Greeks, you're always trying to, we always have vulnerability somewhere, right? So we're trying to hedge against that, the theta, the vega, and having this short leg, those fluctuations, that short leg will benefit for if we have a loss in volatility, if volatility steps down, if we're trying to enter this on a bounce and the call premiums start to switch and we're slightly out of the money. Well, that short leg should hopefully hedge part of the vega exposure that we have on our long option. So if we have, a 50 vega down here, but we have a 47 down here, chances are it's easier for the put premium or the out of the money call premium to step off than it is easier for the at the money, right? premiums are more likely to stay here than it is out here. These rot much easier because they're out of the money versus these are very close to me. Does that make sense, guys?
Only one.
Yeah, makes sense.
One second.
Open the box. Don't fuck it up. Don't bother me.
All right, hold on. I just had to mute him real quick. All right. Yeah, so we went over the little straddle methods. Yeah, that's how I like to do that. In terms of going like far out swings, same principles can still work. You don't have as much of strike selection going super far out of the money or super far in time, but the principles still work with buying or looking at the money straddle. Is pretty accurate far out as well. Let me just find it. Yep, so it's roughly $70 for year out. So $70 range from 325 will bring us to roughly QQQ of 400 and QQQ roughly 250. So if you were looking to take this on the call side, go back to vertical. Right, so we could take either the money would probably be pretty expensive, but do it for shits and giggles. My God, it's so slow right now. You know, buy 325. Let's say sell the 400. Right, cost us roughly 3,000 or $30. We got a 75 wide point spread. We got a year's worth of time. You know, not a bad return for a spread. You know, we could probably, it would be a little over 200% for max profit. You know, you would take this value minus the width of the spread because it's our cost. So the cost minus the width of the spread would give you your max profit. So tons of versatility because you can sell a short option. You're able to leverage yourself to buy a little bit more time. If you don't have the capital to be able to buy a year out, okay, well, since you can sell a further out of the money option or sell another option within create the spread, you're now essentially buying yourself the ability to use time to your advantage. It's a huge, huge, huge advantage to small account traders because, you know, if you're a small account, chances are you're not going to be able to buy as much time. But if you can spread into buying enough time, that's going to be more value for you, especially if you're trying to capture long-term swings. So keep that in mind that it works for all expirations, and taking the straddle range for earnings generally to me is a little more accurate in terms of getting crushed or not crushed for in terms of applied volatility. But we're going to go into the short side of credit spreads now. So setup is the exact same, except it's reversed. So if we're taking call credit spreads, right, or bear call spreads or short vertical call spreads, right? So we're just going to flip-flop the strikes. So in our first example, we bought 325 and sold the 330. Well, for right now, for the example, we're going to sell the 325 and buy the 330. Generally, I don't like to do it at the money just for the principles of the example. We're just going to structure it around at the money because it makes the most sense. Okay. That doesn't seem right. The cost of that. Anyways, all right. So we're going to sell the 325 and then we're going to buy the 330. So we get the same reduction on our Greeks, right? So if we're short the 325 up here, you know, we're short 47 deltas, and then we're going to buy 34 deltas. So we got roughly a negative 13 delta on the trade because we're short, predominantly short. So it's negative deltas. Pretty flat for gamma. Even though this could explode against us being at the money anyways, even though there's no gamma sensitivity, we could absolutely lose in this option being right at the money. You know, theta's always going to benefit us. We are reducing it a little bit, buying this option out here, but it's going to cover any marginal costs that we have, you know, just being 5 points wide. And we have a slight, and we're selling slightly more Vegas than we are. So implied volatility is going to work for us being a short option seller. So if we're selling 325, it's going to be roughly $6.30. And then if we buy the 330, it's going to be roughly $4. It can give us a cost of roughly $2.50. And we're selling a 5-point wide spread, right? So normally in that case, if we were in a long debit spread, that would be our max profit, would be the extra $2.50. But since we're selling this option, the most that we can make on the option is the amount that we're selling it for. So if we sell this option, or this spread, I'm sorry, for $2.50, then that's the most that we're going to make on the trade. If the stock by Feb 5th, let's say it doesn't close above 325 and expires out of the money, then we received the full $2.54 that we sold the option for originally. However, I generally don't like to hold all my spreads close to expiration. I normally just like to capture roughly to around a low of 30 cents, because I find to be anything under 30 cents or a quarter left on the option is generally the hardest to rot away. So for option purposes, I like to capture all the movement up until, and then usually I close it either early Friday when the vol drop down happens. But in this case, if the option, or the stock went down, which I'm pretty sure QQQ did it this time, we're gonna benefit. The option is going to erode at the rate of our delta. So that 13 delta that we had on the spread, it's going to work for us. The time value is going to work for us. The volatility is going to rot on these call options. And we're going to want this 325 mainly to, completely wither away. And we don't really care what happens with the bot option at all. We want that to expire worthless too. It's just there for covering our margin costs. Now, how much margin do we have to put on this play? So if we're selling an option for $2.50, and we're on a 5-point wide spread, generally we have to put up $500 in marginal cost. But if we're selling it for $250, we should only have to put up $250 in margin, because we're selling 5-point wide spread. We got to cover that $5 cost. So our collateral would be $250, and we're selling it for $250. It should be roughly $500 we have on the trade per spread that we're selling. Does that make sense? You're gonna mute yourself. Reach, I only muted you because there was someone talking.
My bad. Yeah, it makes sense to me. Thank you, though.
Yeah, it makes sense.
Okay, so this is kind of where, right, probability is a very, very, very big factor in the market, right? So when we are short options, naturally more options expire out of the money than they do in the money. So we gain, as a short option seller or a short spread seller, you have a statistical edge on your side, right? Similar to if us four go to the casino, the longer we're at the casino, the more money we're likely to lose, but the more money the house is likely to make. The longer an option buyer is in the option, statistically, they should lose more money, right? If Reach buys an option at 9:30 and holds it till 4, he should technically lose value on his option. Just like any of us. If I sold that option, the longer Reach is in the trade, the more money I'm going to make. That kind of makes sense. Kind of the house and casino odds. That's basically how most people who are selling put credit spreads and trying to create passive income. That's kind of the idea that they like to take. Take the same setup 10,000 times, as long as you have a 51% edge, in the long term, you should see profitability, in the amount of times that you're trading and the amount of years that you're trading. So flip to the put side real quick, because put selling probably the most common form of option selling. Generally because it's bullish and you're allowed to be neutral. When you're an option buyer, you cannot maintain a neutral position. There's no way to do it. If you're a stock buyer, you can't be in a neutral position. There's no way to do it. Being short options, the actually only way you can be in a neutral position. Even though we're selling a put and we benefit from the stock going up, and it's still technically a directional bet, if the stock goes nowhere, doesn't go up or down, the put seller still benefits and the call seller still benefits. So being an option seller, again, you gain the ability to be neutral or have a neutral bias in the market. If you think that the market is going to be consolidating and then going to make a bullish move up, well, then you're probably a put seller, because you can be in that trade right? You can, if the market just came down from a big drop, just like it did in the past week, okay, well, you can load up on selling puts if you think the market's going to consolidate at these levels where naturally the put volatility will mean revert. So come down in value, the options will lose the Vegas and lose implied volatility. And then let's say it starts to make that move up, and that's where that bang, that's where that vol crush happens in the puts, and then the stock starts to go up. That's something a put seller is able to do. If you're buying calls and you're trying to hold in that consolidation period, what happens? You generally hate your life because you see your premiums get withered away until you see the breakout, and then that premium then gets restored in your contract. So that's where the option sellers, they gain true full potential. So if we're setting up put credit spreads, what I like to do, if we're not going into an event, there's no earnings, FDA approvals, any macro event, just typical. I like to go one standard deviation out. That one standard deviation can always take roughly to be whatever the at the money straddle is trading for. In this case, it's probably roughly around $10 to $11 because call is trading for this and it's trading for that. So just add them together. It's probably 10, 12 bucks. So we come down, stock's trading at 324. Let's go down fucking 12 bucks. We'll take the 313. So sell 313. Shit, let me go back to this. We'll sell 313 and then we'll sell 308. And buy the 308, I'm sorry. Right? So roughly for 90 cents, we're selling the option, still 5 points wide. We're selling it for $1, but we have to put up another $400 in marginal collateral to cover the cost of the trade in the event, assignment happening, and we're roughly 5 points wide. The wider we go in between strikes, if I move this bot option out farther, let's say I move it to the 300 strike, well, that's $800 more that I'm going to have to put up in collateral because that's the width of the spread. Even though I may receive an extra $70 credit for doing that, I'm still putting up more collateral. So a lot of people don't like to go heavy on the collateral because it takes up a lot of money in their account. Yes, let's say this trade could be profitable and it absolutely works out. That's great. They still don't want to have to put up that extra added, it's not really added risk, but potential risk that they have to take out and taking up room in their account where they could be moving, that money to different assets or underlyings in the market. So if we're capturing that put premium, this is kind of the way to do it. If there's any time we're nearing an event or if the market seems to be extra volatile, like right now where with the VIX was moving closer to 30 and vol Qs in the 30 range, you're going to want to go possibly 2 standard deviations out. That will probably be better suited for a slightly farther time frame than just 1 week. Put credit spreads are great, in the month range period, trying to capture the step up in gamma and theta. In them, obviously, there's going to be soon to be more implied volatility sensitivity. So you're looking to catch that erosion. So you could go 2 standard deviations out, which if we take our straddle again, we're just going to take 2 times the straddle, 2 times roughly the implied range, right? So for a 25, we're just going to take $24, $25 range. And again, in the front week, you're not going to see the risk reward won't be as good, especially on ETFs and indexes. Volatility is naturally lower. So the risk reward especially won't be as good, but on names that have more volatility, you'll see a better premium style setup. But people like selling puts and stuff on index funds and ETFs because they like to be stock, gains them exposure to multiple stocks without having as much risk on the table. See, like right here, this is a high probability spread. Chances of this spread expiring out of the money, they're pretty great. But you're putting up $2,500 in risk to only make $100. That's not really a trade that you'd want to take. There's not as much the risk reward is not there for you versus the one we went over before where we were selling something for $250 and only having to put up $500. That's a much better risk reward for you, even though that setup was at the money. Not ideal, but there are times you are going to be able to sell something that's more overvalued. Names like that have super high implied volatility, like the Mara, the Riots. Hopefully these adjust relatively quick. You're going to see, much more explosions involving. You're going to see maybe some more inconsistencies, right? So, let me go to vertical. This is going to end soon, so I'm going a little fast. Right? So if we're selling the 415 and then we're buying the 14, we're selling it for 16 cents and we only have a 50, or a 50 cent wide spread. That's a 50 bucks. That's a max margin we're going to have to put up is $50, but we're selling it for 16 and only essentially risking the extra $34. So like for us, that's a pretty high probability trade. You know what I mean? We're not putting up much capital and we're making, a little more than 25% of the $50 anyways. Not a bad setup to take. And these are option inconsistencies that you can find when you start to see explosions of volatility. If you go a little farther out, probably find some better setups. Must not be traded. Yeah, there you go. 5 point wide, 144, and a cheap name. Something you more likely can take. Would take some time, 30 or 45 days out, but there are going to be setups, like I said, you can take with plenty of high implied volatility. All right, guys, this is going to end. I hope this helped. If there's any questions, definitely feel free to ask now. It's another 5 minutes on the timer.
No, you did a good job explaining all that stuff.
Yeah, and this is gonna, like, in terms of taking these trades and analyzing volatility in the markets, this is how you learn to cover exposures and hedge against exposures, because you could take a position that's essentially already hedged. You know what I mean? So if I'm only taking a small position that I know could probably happen, I don't have to essentially outlay much risk, because I'm not trying to catch the home run bangers every day, the 2% drop that happened. There's ways to stream other incomes out of the market, and there's other spreads that are, and this is just the basic setup of the spreads, and there's other ones that you may like that aren't necessarily premium collecting ones. They could be more long side, but they essentially can get you to pay for your long positions. So we'll roll that into the later time, but I'm going to see if I can get both these videos up if you guys don't have any more questions.
Cool, thanks.
No, I'm
Reach.
good as well. Thank you.
All right, boys. All right, feel free to text me, any questions, any charts, whatever, the deal.
Awesome.
Not then hopefully we'll be on tomorrow, boys. Hopefully I got the new Astros and I sound a little better.
For sure.
Awesome. Catch you later.
All right, boys,
See ya.
take it easy.